the file, which I then have to also process to make it fit on YouTube. So I'm just going to use my own Camtasia to record, and that usually is pretty good. Okay. Alrighty, I think we're set. Let me get the recording started here. All right, good evening, everybody. It's Ken at Tortoise Capital with the question and answer webinar for lesson number 5. It is February 11th, 2018, after quite an extraordinary week in the market. So let's just jump right into things. I should say that I've added the weekly report review and a daily debriefing from Friday to the YouTube channel, and I've posted those links in the chat room and in the Q&A session link here. And then also, if you look on the right board for the podcast, so if you go to, let me show you where that is. If you go to this one, Live Portfolio Management and Daily Podcast, I've added these in here, the daily debriefing for Thursday and Friday, and then also the weekend report review here. I should also mention this one here, the debriefing on the Swing Turbo for 50R. That was the, I think I want to say it was Wednesday. It was either Tuesday or Wednesday, and that was sort of the culminating event for the large swing moves that we saw this week. Those are all worth watching. Okay, back to the... All right, so question number 1. When scanning for sectors that outperform the market and stocks that outperform the sectors, what look-back period should we take into account? 3 months, 6 months, both blended? And I'm going to suggest that, relative strength only makes sense when you look over a particular holding period. There's no relative strength in an absolute sense. It's relative to what? Relative to another symbol and relative to a particular holding period. And so my answer would be is that whatever your intended holding period is, then that should be related to the type of trading that you want to do, or it could be the type of setup that you're going to do. So if I was looking at like the auto framer, that's a 10-day, it looks at a 10-day high as the measured move back to the 10-day period, right? So where is my pencil? There's my pen. So if I was looking at a 10-day high, and I had the first symbol had fallen this far, and it was 5%, a 5% loss. And then this symbol had fallen 15% from its 10-day high. And on one hand, I would be entitled to say that symbol number 1 had better relative strength than number 2 because it has fallen less. On the other hand, in terms of relative opportunity, if this thing actually were to find a bottom down here and then give me a reversal and start moving up, and if I'm playing for a target up here of the return to the 10-day high, then the opportunity is certainly larger on this one than on this one, which only has perhaps a 5%. But in this case, I would say symbol number 1 has relative strength because its performance over the 5-day measured period is much better. It just so happens that the strategy that I'm looking for, in this case of the auto framer, is looking for relative weakness. On the other hand, if I'm looking for, let's say, like a blended monthly rebalancing, and I have 2 symbols, and one of them has returned, 1%, and the other has returned 3%, and there's sort of been this consistent outperformance all the way through, over this whole period of time, this period of outperformance, I should say. Then it really depends on how long I want to hold this. Now, when I look at the blended monthly rebalancing, I'm looking forward to holding it for a forward period of 1 month before I make my next decision. And so in that case, I'm using a 3-month and a 6-month blend to come up with my relative strength number. And so to hold for 1 month, a 3 and 6 month look back period looks reasonable to me. If I'm holding for 2 weeks, maybe I can just use a 1 month. So if I only wanted to hold for 10 days, maybe I might use a 1 and a 3 month look back, or I might just use a 1 month look back. Another simple way to look at this is the regression line, 30 slope. The regression line 30 slope is sort of my preferred method of looking at things in this relative time frame as a swing trade in this period, like the 3 month and 6 month. If I'm thinking about swing trades, I like to see, we got individual prices that look like this, whatever that may be, and then we draw a 30 period regression line, and then I can measure that slope value, which is the measurement of this angle. And so that green one, or that aqua one, is better than one that looked like this. And so the improvement of this, that increase of that angle right there of slope over this one, makes that relative strength look better. So the short the short story on this one is that if I'm looking at max pain and max gain, I really think it comes down to the holding period, and then you say, well, there's a hidden question there: is what's the right holding period to be looking at? And I think it comes back to what kind of a trader you want to be: intraday, swing trader, or position trader, or an asset allocator. I think of position trading as being something like our monthly adjustment, or even once a week you're looking at your stuff. Whereas a swing trader, I think, looks at end of day. In that fuzzy middle, I would think the times that make sense to me are 10-day holding period, 1 month holding period, the 3 and 6 month blend, and then maybe an annual performance rating. I think those are sort of some natural categories. The max pain, max gain that I mentioned here is from the 10-day high. If you look at that on the daily report, that's really looking at the 5. That takes the, as an example, the members of the Dow and ranks them from 1 to 30 on the basis of how much they've lost from their 10-day high, whatever that 10-day high is. And then it measured it on a percentage basis how much each one has lost. And what the max pain ones look like are the 5 worst, and then the max gain are the ones that have lost the least. And so what I like to look at are, I think there's gold in the extreme. So this extreme and that extreme, that's where the value add is. I think that's the ones that are most likely to make extreme moves during swing trades, and that's why I isolate them. So this is a case where I'm only looking at a 10-day period, and I'm trying to get those kinds of pops. Okay. Okay, number 2. My understanding is that it's best to trade in the direction of the long-term trend, long in a bull, short in a bear. However, I see you now are taking short swing positions despite still being in a bull. Do I only do this after a major run-up in the market? If so, what are the setup criteria? Does the slope stat need to get above 2 SD, above the average, and then roll over? And I would say in general that is correct. Let me see if I can open up that the weekend report. Yeah, the first thing to notice, we're in extraordinary conditions here. That slope, that risk Z is down at -4 sigma. But when I look at the daily report now, and what I'm looking for is, yeah, this one right here. What we saw was in this last week, we saw the slope stat get to we saw that slope stat cross over its own 10-period moving average, and here this is the long-term average. So it was 1, 2, 2.5 standard deviation above normal. When it gets that high, those kinds of moves are very hard to sustain, and so now what we can look at is say, when this occurs, more than 1 standard deviation above that long-term average, then it's quite possible for this to be an exaggerated bull or an over-exaggerated bull or an exceptional bull. And now the retracement can be quite extraordinary. And if you look at this retracement here, it was a 5 standard deviation move compared to the 200-day moving average. So this thing had gotten, if that was a moving average, this thing had gotten so far stretched above the 200-day moving average so fast, this asymptotic move, that the snapback was extraordinary. And I think that's a combination of people taking in a hurry to protect their outsized gains, because a lot of those gains probably came from people using a lot of leverage and then building on markets money with more leverage. And so you get a parabolic move to the upside. And so although it's a bull move, it's a risky bull because it is a flat-out adrenaline rush. And so now I'm willing to get short on that because exactly of what you just saw, these kinds of incredible snapbacks. Where I'm not likely to get short in a bull is if you have, if this was sort of the 200-day moving average, and then the price was moving around in here, and it's been gaining only incremental, slowly pulling away, and it's grinding, and there's buying and selling and backing and filling, and it's doing fine, then that's okay. I really don't want to get short on that one because then you'll get ground to death, right? But if you get some kind of move where this is now, the difference between these two is like 2 sigma, that's what we saw over here. This move is so extraordinary that this this extra gains was so abnormal that as soon as it started to fail, people started to rush to sell faster than they would sell in a grinding bull. And so that momentum attracts sharks. And then it's sold. And then what you have at first was, I think, maybe concern, and then some anxiety, and then a little bit of fear, and then a whole lot of panic. And so you get these, maybe this was concern, fear, panic, and you get these kinds of extraordinary days. So when we hit that, the purpose of this chart here, chart number 3, is to show how steeply good is that slope stat. How much above the long-term average has that recent 30-day performance been? And when it gets above 1 sigma, the first green line, any crossover over its own 10-period moving average, even if it had crossed over here or here, those can represent important changes in the swing market condition. And then the move back to the long-term normal, even this can actually be a good short trade. And so now when we're up here 2.5, almost 3 sigma, then the move can be extraordinary, like you saw this week. So that's in general, I don't like to go short in a bull, but under special conditions. Now, this was a case where the market itself was overheated, and so all of the relative strength leaders in the market were also overheated. So the other place that I'll get short in a bull is if you have a normal bull, but there's a couple, maybe there's a symbol or a target that's had its own little extraordinary moment. And so maybe that becomes so powerful that can be shorted safely. But yeah, that's how I would answer that. So anytime the slope stat, the risk Z, etc., any of these measures of market performance get outside of 1 standard deviation above average, I become much more alert for changes in directionality, which are usually sharp and surprising, which is perfect for a swing trade. A swing trade is based on a temporary anomaly in the market, where price gets too much out of the norm one way or the other, and then people see an arbitrage opportunity to trade it back to the mean. That's sort of like that mean reversion trade that Dr. Howard Bandy talks about. And so it still has to prove out on the framing for the reward to risk criteria. So that becomes the essential element of trade framing there. Okay. There was a question: how long will we have access to the recordings once the course finishes? Unlimited. I would recommend that you remain a silver subscriber at a 50% discount. So right now, silver subscribers are at $2,000 a year by virtue of taking this course. And generally what I offer folks is, that are repeat customers, is I give them a discount on the silver. And that way you can maintain connection with the chat room and the community of practice, and that feels like an appropriate subscription level. So, but really unlimited, and I don't mind if you download the videos, just don't share them with others unless you think that's okay, and I trust your judgment. Now that we are in bull volatile conditions, and I would just note for a moment on Thursday we were in sideways. A possible next scenario might be a move to sideways volatile, assuming volatility remains elevated for a few months. How do we determine when a move from bull volatile to sideways volatile is happening? Well, the first thing is there's a very strict mathematical criteria for what that for the definition of bull versus sideways versus bear. And it really comes down to this, that the bull sideways or bear is price relative to the 200-day moving average. It has to be more than 2% above the 200-day moving average in order to be bullish. If it's within 2%, plus or minus, of the 200-day, then it's sideways. And if it's more than 2% below the 200, then it becomes bearish. So the way to check that is over here on the market mosaic. And right now it is 3.04. And so that means it's bullish because it's more than 3% above. The fact that that cell is red means that this is one of the worst readings of the last 6 months. And then volatile, normal, and quiet is a function of ATR percentage compared to the last 100 days. And let me show you where there's a chart on that one. That chart number 8 shows SPY volatility, which is the ATR divided by the price compared to the last 100 days. So if it's between the green and the red line, that's the black line is the average of the last 100 days of ATR percentage, which is just above 0.5, and then the standard deviation plus or minus band plus or minus 1. So everything between the red and the green line would be a normal volatility. So you can see we're like 2, 3, almost 5 standard deviations above the long term over the 100-day average. And it has to get below the red line for it to be quiet. So on the daily chart then, chart number 8 tells you the how close we're getting or what direction we're going in terms of volatility. And then on the front page, you can see where the time series is. And that's price relative to the 200. And again, if you look at the, you can look at the price stretch over here on chart number 4, SPY stretch percentage versus the 200-day moving average. If this thing gets above, that's measuring how above or below the 200 it is. And then that gets reported on this chart here. The market mosaic item number 2. Okay. If we are in a follow-up question, if we're in a sideways volatile, will we still interpret and act upon the seasons of the risk Z in the same way? Yes, the risk Z is actually much more sensitive than the market classification. So the seasons of that risk Z is if it's below the 0 line and getting worse. That's the winter. And then when it gets better, this is the spring. When it crosses the 0 line and going up, oops, sorry. That would be the summer. And then when it rolls over and starts coming down, that would be the fall. And so, in general, you want to be planting in the spring. You want to be growing in the summer. You want to be thinking about harvesting in the fall, or possibly a second crop. And then you want to rest and let it be fallow and look just for short-term opportunities in the winter. So the 9-segmented market classification strategy. What that says is any bull any of these bull conditions plus sideways quiet are good on the long term. That has a micro advantage for swing trading. This little indicator from the daily report has a micro advantage. The important one to me is the risk Z. That's much more sensitive because the volatility can change so fast. I mean, look, this was almost a 5 sigma move. well, it was a 5 sigma from here all the way down. 5 sigma that happened, in 20 days. And in that time, it went from bullish normal to bullish volatile. Thursday, it became sideways volatile and moved back into bullish volatile. So the risk Z is much more sensitive, and I would use that as the primary guide to the seasons of the market for swing trading. The other market classification idea to me is more useful for maybe the longer term swings. I would also say looking at overbought and oversold on an annual and a 10-day basis also is significant towards the seasonality. And for swing trading, the 10-day NDX to me is probably more important. I think it is more important for me than the broader market classification, which I really think of as like a position trading. When we're in sideways volatile, like we did get this week, I'm much more likely to cash shorter term winners. I want a bird in the hand is worth two in the bush because of the increasing volatility and the chaos that comes from sideways markets. Robo trading the hybrid frog. Let me use this as an opportunity to explain that one. Okay, so the hybrid frog is an intraday technique that I think is useful for the opening of the market. So if that's the open, the time frame at the open, right, and the price at the open is here. The hybrid frog takes the idea of placing a frog box on either side of the open, the robo frog would simply from the open place a frog box at the open, and then if the market went through this to the upside, we would be long. When it left the frog box, and then we would be short if it fell out of the frog box. And then we would use, then as this kept moving up, in the frog strat, you would simply be trailing that. So at that moment, the frog box would be, the stop would be like right here. So it would have just trailed that all the way up, and it's always like a frog box from the highest high. Well, the hybrid frog takes that same idea and then and says where our current idea is to use like 0.7. That this you want to take a multiple of the frog box, and what we found is that by shrinking this down to 0.7 and 0.7, then you get into that position. If this was the frog box here and the hybrid frog box was 0.7, what you get is you're into that position 0.3 sooner. And what we found was that by having it initiating at 0.7 instead of 1.0, a 0.7 trailing was still plenty good. Trailing with a 0.7 was plenty good compared to a full 1. So we figured just put that 0.3 in our hand. And the basis for this idea was that the average win was something like 0.6 when we used standard. If we used a standard frog box, like from the open, and there was a swing low, and then we put a frog box on at 1.0, this thing would go, and then when it came back a certain distance, we would cash it. It turns out that in this rule set, the average win was 0.6. And it turns out that to get a 0.6, what you had to do in the standard rule set was it had to move up, get to 1.6 frog boxes from the open, and then retrace a full frog box, and then you would get out at 0.6. So we were given back a full 1.0 frog, right? But then what we found was that once you let that thing move a full frog box off the bottom, I'm sorry, if you got an entry, and if you ever saw that thing go to minus 0.7, how many times did it actually go up and give you that 0.6 win? Never. So what we said was 0.7 was good enough, that if it got that far, you wanted to get out of that position anyway. Don't think, in that last 0.3, it's going to turn around and then go on to win. No. If you get in and that thing immediately fails to minus 0.7, just get out. So by getting in 0.3 sooner, we were adding that extra gain to the average win, and we weren't prematurely cutting big winners out, because it turns out that when the frog goes, it should just go. So that's the hybrid frog. So now the question is, and that's about all I want to say about it in terms of, for the swing course. I can cover maybe more later. But now to robo-trade this, all you're really doing is talking about doing an auto trade by coding that as a system, and then having your broker trade that. So Jeff and Sanal have that skill. Tom Koo has that skill. A number of the traders know how to do the auto trading. You set up easily enough in TradeStation. You can even auto trade the mechanical swing systems in TradeStation with the TradeStation bundles that Bill Brower's put together. So robo trading is nothing more than having a coded system with your broker that has the ability to buy and sell according to rules. And so auto trading the robo frog is a way that you can get, you could look at 10 symbols, for example, and then use the robot to trade the first 5 that fired. Because what you want to do is, the earlier ones tend to be the better ones. So you could robo trade the frog as a technique. That would be similar to robo trading swing trades, but that's a subject for another question. Okay. Question 6, regarding the nice DIA charts in the chat room. On February 7th, I mentioned the profit and loss on a contract. The chart showed the DIA ETF. I'm actually trading the futures. Yes, I do trade the Dow Minis. And it trades identically to the ETF. The trading leverage on that one is like 20 times that of the ETF. So as an example, I'm not encouraging you to do this, but you can do this. A $5,000 account has enough intraday leverage that you could trade 10 contracts. I wouldn't. I'd trade one contract for every 5,000. But the leverage on that thing is such that a penny move in DIA, 1 cent, in the Dow Mini is worth $5. All right, so if it moves $1, that's the equivalent of $500 on a contract. And the Dow Mini is nice because the increment is $5 per point, and you can trade the intraday moves without buying a full up position at $240 a share. You can trade a contract. However, you can lose that money just as fast too. So the power of leverage is not to be trifled with. But the reason I concentrate on the Dow is because I like trading the mini. So number 7. Oh, I'm sorry. There's a follow-up question. Is 10 cents my usual execution stop in trading this intraday? It's usually more like 15 or 20 cents in practice, but 2 points if you get the turn done with a 1, 2, 3 entry. You could live with a 10-cent execution stop. Your position sizing stop would be larger, but certainly that's possible. Can I briefly explain the characteristics of an emerging dragon? Yes. So, price, the emerging dragon is going to essentially look like this. So we have a long and strong trend. So if that's the price, I'm going to now draw the So now I'm going to draw the dragon. So what happens in the emerging dragon is that the dragon is going to have one of these little turning moments, right? And so what the price will, or the RL10 will have done, because it goes faster than the dragon, will have turned and will have crossed and then reverses and comes up like this. So I'm sorry, let's see if we can draw this line straight. Sorry. The absolute hump of the dragon was the upper limit of price motion that we care about. It's the significant moment of price, right? And in the same way, the belly of the dragon, this space between the two blue lines, I think of as kind of no man's land. All right, and now because we had a long and strong successful trade up in this way, we see this as a dip right here in the middle. This is where the X marks the spot. That is a moment of quietude and uncertainty where it looks like this thing has pulled back and started to retrace. And for me, where the X marks the spot is actually, I should have just drawn that as a P for a pocket. The pocket is formed inside here. And I want that to be green because that's a good pocket. Okay. The pocket entry is anywhere from when the RL10 crosses the dragon, recrosses the dragon where he re-entered, and then anywhere between these two blue lines is a pocket entry, because it's a continuation of the previous move. Now, where the emerging dragon entry occurs is when that RL10 crosses the line that's tangent to the hump of the dragon. So if it takes out the hump of the dragon, then that is, in my view, that's what we define as the emerging dragon. Okay, so once we get this little moment where the RL10 now crosses through the dragon, we call that the RLXD. The regression line has crossed the dragon. Right at that line, and then between right after the RLXD all the way up until it becomes an emerging dragon. This is a pocket, and then so the emerging dragon for me is that moment of the the mechanical entry. I have to get in here because now what I have is 100% confirmation. 100% confirmation that price is now higher than it got to on the last excursion up. So the dragon price in the dragon moved up, and then it couldn't go anymore. It started to fail. The dragon rolled over. The top of the hump there, that dragon, is the statistically significant moment because that's the 10-period simple moving average, which I'm just going to, that's the middle of the dragon or his spine is a 10-period moving average. Sorry. And then the RL10 crosses the dragon to the downside, then reverses up, comes back through the dragon, and now this creates, God dang it, wherever that previous swing low was in the belly of the dragon, and then I see this one up in here, I draw that connection between those. The higher low in the belly of the dragon now looks significant to me. So if this was a much bigger move, let's say, this could have been something like, a couple humps up. I would see this as here was a swing low in the belly of the dragon. Here was a next swing low in the belly of the dragon. That's good. Then on the upside, here was a hump in the dragon. Here was a higher hump in the dragon. And that sort of creates this upward looking channel. All of that is good. So inside that context, when you see a grinding bull, you have the belly of the 10, the belly of the dragon. You have an RLXD. This is where I am really stalking that entry as a pocket entry. And all the way up, pocket entries, and then when it crosses that line above the hump at the top of the dragon, this now becomes an emerging dragon. Because at this point, this rascal is now free and clear. And this is that rising dragon's head. He's on his next leg up. There's this moment of hesitation inside here where that X marks the spot, where that pocket occurred, right? So all of that taken together is a technique or a strategy or standard practice for re-entering trades or adding to positions or describing the price behavior in a certain way, and allows us to describe different strategies. So for me, another way I like to look at this would be the RLXD moment. That's where the pocket started. I think you'll hear me describe that as the not earlier than entry. Oh, why did that get so big? The RLXD entry is the not earlier than, that I think you can afford to wait for price to come back through the dragon. That's really the third criteria in the owl pattern, if you will think back to that one, is when he crosses it, that's the not earlier than. And then I think in this case the emerging dragon is the not later than trade. Meaning that I can't afford to wait any longer than that. So when it comes to actual discretion, in my view, your discretion is really in this space between really the emerging dragon and the regression line crossing the dragon. That's where your discretion is. Somewhere in that pocket is the right moment to get in, and then you have to get in not later than the emerging dragon, because quite often that's going to be where the short positions have their little stops, and once it cracks through there, that's going to start firing like popcorn, and then off it goes, because now there's no resistance overhead. So that's the story of the emerging dragon and the regression line crossing the dragon. Okay. Number 8. Looking back through the system notes for methods, the mechanical systems, I noticed some of stock charts coding. Is there a compendium of the stock chart codes available? Yeah. If on the tortoisecapital.net site, there's all the mechanical systems have that coding, but I'm going to, later tonight, I'm going to go and put that all into one document for you so you can do that. You'll have all that stuff in one spot. Number 9, in the exit rules of the washout strategy, and really the other ones, the recent swing low minus 0.05 or 50 cents. What I meant to say on that was that for most Dow stocks that are between like 20 and $100, a 5-cent buffer above or below yesterday's higher low is enough, in my view, to confirm that a new move is underway. But if you had a $500 or $1,000 stock like Apple has been and Google in the past, 5 cents probably isn't enough. And you might not want to use just a 5-cent buffer. You might feel more comfortable with a wider buffer. I don't think that needs to be more than 50 cents, like ever, for it to be a new high or low of the day. So when I'm talking about the buffer, the idea is this one. Is that yesterday's price action was this, some kind of gizmo there. And then today maybe opens up inside the real body and then starts going up. And at some point, I say I want to see a price that was higher than yesterday's high as a trigger to say this is new strength for the bulls. Why? Because yesterday the bulls exerted some strength and they could only go that high, and then they ran out of gas, and then the market came back a little bit and closed here or wherever it closed. But it couldn't get any higher than the high of the day. So if today is going to continue that strength and starts going up, at some point it's going to venture into new territory. So now the question becomes, from the high of yesterday, what's the buffer? What is the size of the buffer? And so I typically just, for swing trading, use 5 cents above and below. I think you could let that become as high as 50 cents if you wanted more confirmation, or if you were trading an instrument that had a very high sticker price. Okay, so that's what that means. Let's see, I just noticed Jim has a question. Let me get to that. Where does the 10-cent stop come from for the mini contract? That's 10 cents is just, it comes from the, it's 10 points. And I actually use like 2 points is what I really want to get it to. So it's only $10. But you could use a 10-cent stop. And if you take a look at, I think you should practice trading DIA. And if you can manage a 10-cent execution stop intraday in DIA, then you can trade the Dow Mini, because 10 cents is a $50 risk, right? So in the Dow Mini, a 0.10 of an initial capital preservation stock, that's the equivalent of risking $50. And you only need to see a 20-cent move to the upside to get your 2-to-1 reward to risk. So you're looking to capture 100 while risking 50 with that dimension. And if you can do that on one contract, you can grow that account. Now, if you take a look at the way we trade intraday with the ETFs, you will see that becomes a reasonable execution stop, especially when we're taking a look at Z3Ps and breakout from sideways client channel or OWL entries. It turns out that looks like a manageable execution risk. Okay, let's see. Number 10. This is really number 10 and 11. So number 10, I updated the daily debriefing videos. There was a bad link in there. I have updated that to the correct link, and that link is here. Are these trade frames posted somewhere ahead of time? Well, here's what I'm going to encourage you to do. Everybody's at a different place in their learning and in their time frames and in the styles that are appealing to them. And so I'm trying to do as many trade frames as I can when I talk about the portfolio management. And I'm going to go over the trade frames for this weekend at the end of the Q&A. But you should be looking to find the patterns and strategies that appeal to you and making your own trade frames and then comparing them to the ones that I do and learning to see that maybe the difference or to see what you can learn from doing that. On the portfolio management review, when I'm adjusting, that's where I'm doing those trade frames. There's too many of them for me to do a separate trade frame for all of them. And I try to comment on the ones that you guys post in the swing room. But normally it will be in the daily debriefing or in the portfolio management. Number 11, a couple of generic questions regarding market updates. Seems like I'm always in for many of the symbols. Is that a result of the recent bull move? Well, I really have like 3 categories of symbols that get onto my action sheet. One of them is all the usual suspects, and these are the ones that are high volume, liquid, volatile enough symbols that are also frog champions in that they are good trending signals intraday as well as on swings. And so that has some broad indexes for me, like DIA, the Russell Small Caps, Mexico, Brazil, Devon Energy, Wynn, Caterpillar, and Home Depot are my current set of, I should add VXX to that too. It used to be XIV, but now it's gone, sadly. So it's not unusual for me to have a position in any or all of those. Like this last 6 weeks, except for this past week, has been a very strong bull move. And so I had positions in all of them multiple times. And I swing trade as well as day trade them. Then there are other ones where that are continuation patterns from a previous signal fired and I'm still in the trade. Now, if I get a pattern that I like a 5DD on a new symbol, and I trade it and it's successful, it's normal for me to stay with that as a continuation play. And then if that happens a lot, then that can actually end up becoming one of the usual suspects, one of my favorite trading vehicles. That's how Brazil and Devon Energy, Wynn, and Caterpillar and Home Depot all got on my list, is because they just kept coming around. I liked the way they trended. I felt like I had an understanding of its price moves, and the amount of volatility was appealing to me. And they tend to have strong intraday directional moves, so large signal versus noise. So there's not a lot of retracements on them. And they tend to swing trade pretty well too. So that's how I use the signal to noise ratio part of the report. Let me see if I can pull that in here. So on the daily report, when we look at signal to noise ratio, this is page 26 on the weekend report, but the signal to noise ratio. Things like emerging markets has a signal to noise ratio of 0.69. What that means is, on average, over the last 30 days, the size of the real body was 70% of the size of the candle, and the tails, which I think of as noise, the wicks of the candle, was only 30%. So that gives you a 0.69 signal to noise ratio on average. And so all of these in the green tend to be ones that have large directional moves. Those are easier to trade, that once they get going, that the momentum persists. Now these other ones down here in the red tend to be ones that have less signal to more noise than signal. And so they are not as easy to trade. So that's one of the ways that something can become a usual suspect. And later on down here, the next question was, there's also a couple of symbols that I have avoided, treasuries and Goldman Sachs, for example. What do I see there that keeps me out of them? Well, I don't trade those two routinely, and I don't have a feel for them. And when I look at their price action, it doesn't make sense to me compared to the rest of the market. They are not as orderly in terms of how they trade compared to the things that I like. And so I don't try to trade them. It just, there's no reason for me to like them. I look at them and it just doesn't make sense to me. I can't construct a narrative for them. Whereas there are symbols in finance and XLF itself that trade in a very orderly manner. And so I like trading them more than I like trading Goldman Sachs. There must just be some pool of Goldman Sachs traders that move according to their own algorithms. Maybe that's Goldman Sachs trading its own stocks with its own algos, and I can't decode that in my head or something. It just doesn't make sense to me, so I just stay away from them. I keep looking at them because they seem like they should behave like the rest of the Dow or the other ETFs, but they just don't. But I'm not giving up on them. Should we give any more weight to bullish-bearish divergences between the regression lines and the MACD? And I would tell you, I don't look at divergences between oscillators. Like this oscillator says bull, that one says bear, and so which one should I weigh? I really just kind of pick one and try to master that. But I understand the point that you're making. So let me pull up SPY real quick and look at it on the hourly charts. This was the nature of that question. And the point was, I think this is the hourly, and this is the 9th over here. So price had made a new low. As you can see, that this low was lower than this low over here. But the MACD histogram, the little the signal line, only got to minus 0.577, and over here it was like minus 0.67. Is there anything to be made from that? I don't really compare between those two so much as simply to say, I mean, I like the fact that this was a low and that's a higher low. But really what I look at is, where is the MACD line compared to the dotted line, the zero line, for directional bias? And then where is it in compared to that river and the moving average? So here's one where I can now start stalking it because it's below the zero line, but it has done an RLCO outside this red river, and is now the signal line is above the EMA, and it just entered the edge of the river. That's the earliest stalk. Look, and that's almost a 1, 2, 3 possible entry inside here. And what it says is that there's room for a reversion to the mean trade back to the dotted line, or in this case, back to the RL270. And so that's fine. But it doesn't surprise me, for example, that the MACD histogram got really low here. And that's because the amount of this fail, the size of this fail, from the Z3P all the way down to here was bigger than the size of this fail. On a relative basis, though, price did get lower. But I really am not trying to explain the difference between those so much as I am looking where is it in the life cycle of this MACD histogram oscillation, and where is it with respect to measurable points of value, in this case the Z2, Z2 river. So all I care about is that it made an extreme move this low. That's what creates the opportunity for a return to long-term fair value in this case, which is the RL 270. Looking at the charts over the weekend, question 14, I see money leaving the market. Where is it going? It can only, I mean, cash, bonds, real estate, businesses on the sidelines, or other people's pockets if you didn't get out. So, I mean, there are other ways to measure those things, and I believe in your own personal money management strategy, you should have something other than equities. Years ago, I used to teach at Man's Infinite Wealth workshop, and one of the things that I would talk about is, I think, diversity comes from, having money, I think, like in equities, businesses, and real estate, as an example. If that was your pie. And then inside equities, this might be stocks and bonds in some allocation, in cash. So, true diversification across those. Yeah, so where does that money go? Heck, I don't know. I think a lot of it's still in cash. A lot of it just got vaporized, though. Number 15, I become confused. How did that happen? I have become a bit confused with the recent flurry of trades in both directions over the past week. What should we be relying on most in deciding to adopt a bullish or bearish posture towards a particular symbol? Risk Z, market trend, individual MACD. I would go in that order right there. For me, the risk Z, and here's why. My premise, my belief, my working hypothesis, and so far so good, is that under normal conditions, when the market is going up, when the S&P is going up, you're going to see some things do great, some better, some not a little better, some not quite so good, some measurably worse, and that kind of stuff. So this range of diversification of performance is large when everybody feels good about the market. They're really hunting specialized opportunities and trying to plow leverage. Well, when that happens, you get a spread of performances. The correlation coefficients with respect back to the S&P can get very wide. But when the market takes a plunge and goes down, what you'll see is everything goes down together. Everything goes together, and they all join the S&P in this mad rush to the bottom. So if the market is worth 50% of the returns of equities, and the sectors are worth 25%, and individual companies are worth 25% of their own performance, it's clear in that model that you have to get the market direction and the market call right. And the market direction, in many cases, is strongly correlated to volatility. One begets the other. That when volatility rises, markets go down. Or said the other way, when markets go down, volatility goes up because of fear. And it triggers a lot of fearful panic selling. And that makes all those things go together. So the single biggest determinant of the success of a swing, a package of swing systems that are correlated to the market, has to be understand volatility and market condition. And so for me, the risk Z is the first go-to thing. It gave us more than a week's worth of warning. The second thing, I would look at market trend. I would look at the slope of the 30-period regression line. The RL30 also gave us very good indications well ahead of time. Then I would look at these same measures. I would look at the slope stat for the sector and for the company and where it is in its life cycle, and then really the MACD for directional status. That's the way I would go. Risk Z, slope stat, the MACD histogram, and then trade location inside that 10-day trading period. Now, as far as the lots of trades, short-term trades in both directions, yeah, that's because it's been a 4 standard deviation week, and I was well prepared for short-term intraday moves, and I want to make hay while the sun is shining. There were some major gains made on the intraday side, all driven by those swing targets and preferences, but exploited using turbo techniques. And I see that as just a natural extension of the swing into shorter time frames. When things get slow, quiet, and grinding, like it was for most of January, trades are only in one direction, and there's not a whole lot to do other than just adjust the stop up at the end of the day. That's an example of how quickly the market can change in a 5-day, 10-day period, and the effect of having to adapt your strategies to reflect market conditions. It doesn't mean you have to trade like that in the last week. It's just that you want to be prepared. Yeah, I'm getting some feedback on this end through the microphone. Is that what you're referring to, Paul? Really hard to follow. Yeah, so it sounded like the feedback stopped, so I'm gonna try to plow on through this. We're almost done, and most of these answers are in writing anyway. Where did that feedback start happening, guys? So I can see what I might need to have to re-record. Alex or Paul? Okay. I think then let's just call it right there. We're about 90 minutes in, and I think the answers to 16 and 17 are straightforward, and so I'm going to leave it at there, and we'll try to get this coded and reposted, and then if you need me to repeat any of that stuff, I will try to re-record that. It may simply be because I'm using 2 different recording devices at the same time. I'm trying to use GoToWebinar and Camtasia. So if you need me to repeat any of these comments, just send me a note. We'll roll that into the next lesson going forward. Okay. What I'm going to do is do a separate recording, not in the webinar, of the trade frames and positions, and record it strictly with Camtasia, and then post the link in the chat room and on Basecamp, and that way you can see that. All right. That should be up in about an hour. All right. So that's everything I want to cover tonight. Thanks, guys. Hang in there, and we will see you in the chat room.